Quality dividend ETFs are solid investments for any serious long-term investor, and they are particularly valuable investments for retirees or those that will be retiring soon. In this video, I will cover my top 5 dividend ETFs for a variety of retirement situations. If you enjoy videos like this, please consider giving it a like, subscribe to the channel if you haven't already, and most importantly, drop me a comment down below. I'd love to hear about your favorite dividend stocks and ETFs. And if you're new to the channel, welcome. My name's Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. 3 key metrics of dividend stocks. I think it's important to discuss the vital components of a dividend stock before we dive into our top 5 list. The 3 key performance indicators are the dividend yield, the dividend growth rate, and the price appreciation. Dividend yield is based on the nominal dollar amount that the dividend stock or ETF is paying you each year. It's the direct cash flow of the holdings. Money in your pockets. To calculate the dividend yield, you take the cash paid per share divided by the share price. For example, if a company pays an annual dividend of $3 per share and the share price is $100, then the dividend yield would be 3%. That's 3 divided by 100. Dividend growth rate is the annualized rate of growth of the dividend that's paid. And this is sadly often undervalued by investors because people want that cash flow now. Dividend yield has a lot more oomph behind it the day you buy that stock or ETF. But the dividend growth rate is quietly the more important long-term component of a dividend ETF. And we're gonna dive into an example of how that works here in a minute. And the last of the 3 is the price appreciation. And this is the increase in value of your holding from the time you buy it until the time you wanna sell it. The gains from this are known as unrealized gains or losses until you sell the stock or ETF. For example, if you buy a share of a company for $100 and 3 years later, it's worth $150 per share, you're sitting on a $50 unrealized gain. And if that company also was paying dividends, let's say $5 a year, you would have an additional $15 that's trickled directly into your pocket. So your total gain on that investment is sitting at $65. That's the $15 of cash you've received from the dividends and the $50 of increased value that you're still sitting on that has not been a realized gain yet. And to make this more relatable to anyone with a typical job, price appreciation is like your salary increasing over the years. If you start at say $50K a year at your first job, and then maybe you jump up to $55,000, and then $62,000, $68,000. Over the years, your salary is going to increase on the job. Now, dividend yield is like a bonus that you get each year. This is completely separate from your salary. It's extra cash directly into your pockets. And dividend growth rate is like the percentage increase of your bonus each year. It doesn't directly add to your total return, but it does drastically increase it over the years as your dividend yield continues to increase. It's like the good version of inflation on steroids. For example, having a $10,000 bonus at your job each year for the next 20 years is like having a high dividend yield with no dividend growth. Having a $5,000 bonus that year, but one that grows at 10% per year for the next 20 years is like having a lower starting dividend yield that grows over time and compounds as the years go by. Let's take a quick look at how this example plays out over the years. As you can see, the higher yield looks real good in the first few years compared to starting low with that 10% growth. And as you grow it, it doesn't feel like much is happening. Compound takes a while to ramp up, but around year 9, you start to get a bigger bonus than the one on the left. However, with the time value of money, you're still pretty happy over here. But then you go down to year 10 and on, 15, all of a sudden, you're at double the bonus every single year in year 16, but then you're triple it in year 20. And as you can imagine, this escalates exponentially as you continue to go on in years. We're ready to dive into my top 5 dividend ETFs. First place, none other than SCHD. SCHD ran away with this first place. And look, I am an SCHD fanboy, as you may know from previous videos, but that had nothing to do with me ranking this number 1. SCHD beat the second, third, and fourth place dividend ETFs on this list in each of the 3 categories that we discussed earlier. It was first place across the board. Let's hop over to take a look at the stats. SCHD is the Schwab US Dividend Equity ETF. It has a very low expense ratio of 0.06%. It seeks to track the performance of the Dow Jones US Dividend 100 Index by using full replication technique. And that's key because it tells us that it's passively managed, which is a major plus for long-term investments. SCHD has a nice variety of holdings across multiple sectors. It has quite a bit of weight in industrials, healthcare, financials, technology, and consumer defensive, anywhere from 18 to 12%. And it also has a nice slice of energy, consumer cyclical, and communication. The top 10 holdings in SCHD are pretty balanced. No one stock is over 4.5%, and the top 10 account for about 40% of the weight. SCHD has 104 holdings. The top 10 consist of Cisco, Amgen, the Home Depot, Broadcom, AbbVie, Chevron, Merck, Verizon, Texas Instruments, and Coca-Cola. So diving into the dividend stats here of SCHD, it has a pretty nice yield of 3.54% in its trailing 12 months. Its annual payout is $2.60 per share that you hold. It has a ridiculously impressive 5-year growth rate of 14%. You saw what 10% did on that bonus example earlier. And it's grown its dividend for each of the last 11 years. So over the last 5 years, the price return, that price appreciation, is 31%, and the total return is 45%, so that includes the dividends. In the last 5 years, you're looking at 39% on price return and 64% on the total return. And over the last 10 years, the price has gone up 115%, and the total return is 193% when you add in those dividends. Second place, VIG. VIG is on the lower side of dividend yield. However, its solid dividend growth rate and total returns over the years gave it the nod for the number 2 spot. Let's see what this looks like. VIG is the Vanguard Dividend Appreciation ETF. It has a very low expense ratio of 0.06%. It seeks to track the performance of the S&P US Dividend Growers Index by using a full replication technique. So much like SCHD, it is passively managed. Its holdings breakdown is relatively balanced by sector. It is a bit tech heavy. Most ETFs are these days. It's about 23% technology, and then financials, healthcare, industrials, and consumer defensive make up anywhere from 18 to 12%. Consumer cyclical, basic materials, energy, utilities, and communications get a small slice as well. VIG has 317 holdings, so you may view that as a bit more diversified than SCHD. In a similar fashion, it doesn't allow any company to get above 5%. Its top 10 holdings are Microsoft, Apple, United Health Group, JP Morgan, Johnson & Johnson, ExxonMobil, Procter & Gamble, Visa, Broadcom, and the Home Depot. So you can't get much more blue chip than that. And the top 10 holdings only make up 31%, so this 317 is pretty well spread out. It has a lower starting yield of 1.92% in the trailing 12 months. That's $3.11 per share that you own. It has a very impressive 5-year growth rate of about 10%, and it has 9 years in a row of dividend growth. For the charting of this one, I'm looking at total returns here, and I left SCHD, so we're gonna build this thing up as we build our list out. In the last year, VGT is ahead of SCHD 10 to 4. Over the last 3 years, you have a 35% return. And over the last 5 years, you have a 62% return, which is very close to the 64 of VGT. And over the last 10 years, you have a very solid 182% total return. And that's just trailing the SCHD, which is 193. Third place, VYM. VYM does have a juicier starting dividend yield, but it does fall a bit short in total return and dividend growth rate. However, it still held on to that number 3 spot. Let's check it out. VYM is the Vanguard High Dividend Yield ETF. And just like SCHD and VIG, it also has a 0.06% expense ratio. The fund seeks to track the performance of the FTSE High Dividend Yield Index by full replication technique. So again, passively managed, which is great for long-term investing. Its holding by sector is quite a bit different than the first two. It's very heavy in financials with just over 20%. And then consumer defensive, healthcare, industrials, energy, and technology are anywhere from 14 to 10%. And then it has a nice little chunk of utilities and consumer cyclical as well. Its top 10 holdings does have some of the names we've seen from the other two, and that's JP Morgan, Johnson & Johnson, ExxonMobil, Procter & Gamble, Broadcom, Home Depot, Chevron, Merck, AbbVie, and Pepsi. And the top 10 holdings only make up about 25% of this ETF, and it has 465 holdings, so a lot of variety in this one. It's a relatively high yield of 3.13% on its trailing 12 months. That's $3.34 per share that you own. Its 5-year growth rate is 6%, so you're still beating inflation by a solid amount, and it's grown its dividends for each of the last 12 years. VYM's total returns are 5% in the last year, compared to the 4 and 10% of SCHD and VIG respectively. In the last 3 years, it has a nice 43%, which is just behind SCHD, but well ahead of VIG. In the last 5 years, it has 43%, and this is where SCHD and VIG begin to pull ahead. And in the last 10 years, it has a solid 150% return compared to 193 of SCHD and 182 of VIG. Fourth place, Dgro. Dgro is on the lower side of dividend yield, and it's by far and away the lowest of these four so far on the dividend growth rate. However, it does have solid total returns that made it eke its way onto this list at the number 4 spot. Let's take a deeper look. Dgro is the iShares Core Dividend Growth ETF. It's $51 per share, and it has an expense ratio of 0.08%, so just a touch higher than the first 3 that we discussed. It seeks to track the performance of the Morningstar US Dividend Growth Index by using representative sampling technique, meaning it is passively managed, which is great for long-term investing once again. So breaking it down by sector, you see that it's fairly heavy in healthcare, financials, and technology, anywhere from 17 to 19%. And then it has industrials, consumer defensive, energy, consumer cyclical, and utilities with a nice slice as well. Its top 10 holdings are somewhat similar to VIG, with Apple, Microsoft, Exxon, JP Morgan, Johnson & Johnson, AbbVie, Chevron, Procter & Gamble, the Home Depot, and Broadcom. And those top 10 holdings are only about 27%, and it has 433 holdings. Its starting dividend yield is a little less juicy at 2.39% on its trailing 12 months, and that's $1.23 per share that you own. It has a very nice dividend growth rate of almost 11%, and it's grown its dividends for each of the last 8 years. In the last year, the total return is 7%. That puts it roughly in the middle of everything we've looked at. In the last 3 years, it's at 38%, which ranks it 3rd out of the 4. In the last 5 years, it's at 56%, which again ranks it 3 out of 4. And in the last 10 years, it's at 152%. Fifth place, Jepi and Jepq. Now I'm cheating a little with Jepi and Jepq. These are actively managed funds that have a little higher expense ratios, which is something that I considered when screening out these top 5. But the expense ratios are pretty reasonable for what they give you. Jepi and Jepq have the highest dividend yield on this list by a landslide. Now, I don't consider these the greatest long-term investments because instead of Jepi, I would say buy VU, which is the index that it plucks companies from and then makes the covered calls with. And instead of Jepq, I would recommend QQQ or QQQM, which is its index that it plucks stocks from and then makes covered calls on. However, if you're looking for cash flow now, Jepi and Jepq are superior to the indexes that they use, and they're superior to all the other dividend ETFs that we've talked about so far in this video. I have a confession to make. I actually have Jepi and Jepq as part of my cash position. I combine these two covered called ETFs with a money market from Vanguard, VMFXX. And just to be crystal clear, I am not saying that you should necessarily buy Jepi and Jepq as part of your cash position. I do this because I have enough money in the money market to reasonably cover any emergency bill that could come up in my life. So the emergency savings are there. And I highly recommend that you also always have a chunk of your money in either a high yield savings account or a money market. Jepi and Jepq are my greedy cash. Let's jump over and take a look. Let's check out Jepi first, which is the JP Morgan Equity Premium Income ETF. It's priced at about $55 a share, and it has a 0.35% expense ratio, which is very low for an actively managed fund. Jepi strives to make money with two different methods. The first one is it buys what it deems as value companies within the S&P 500. It tries to buy the companies that have the least volatility within that index. And then the second way is through equity-linked notes, ELNs, by selling call options with exposure to the S&P 500 index. Jepi's holdings are pretty well diversified, as you see about 18% technology, and then healthcare, industrials, consumer defensive, and financials are all anywhere from 12 to 13%. And then you have a slice of consumer cyclical, communication, utilities, and basic materials. The holdings stay very diversified, with only 15% of the ETF being made up of the top 10 holdings and nothing over 2%. There's 139 total holdings. You see big names like Amazon, Microsoft, and many others. Where Jepi shines is on its dividend yield. You can see it's at a 9.71% on the trailing 12 months. With Jepi's short 3-year history, we can't go to the 5 and 10-year metrics, but we can look at over the last year, Jepi has a total return of 11%, which is the highest of all 5 of these ETFs. And in the last 3 years, it has a very respectable 38% return, which puts it right in the mix of all these other ETFs. And Jepq is the JP Morgan NASDAQ Equity Premium Income ETF. It is basically Jepi, only it is based on the NASDAQ index as opposed to the S&P 500. It has the same 0.35% expense ratio. Its holdings are very technology heavy, just like the NASDAQ that it's based on, with 50% being tech, and most of the other holdings being communication and consumer cyclical. Its top 10 holdings are all of your big boys from the NASDAQ. 47% of the total weight is in the top 10 holdings, so it's a little more concentrated, and there are only 90 holdings. The dividend yield for Jepq is 11.44% in the trailing 12 months. And this will very likely be higher than Jepi long term, most think, because of the volatility of the NASDAQ, and the options are a little juicier. It's $5.53 per share. And it's too new to have other stats, so I won't dive into returns. It's done really well in its short history, but we'll cut it off here for now. A great dividend ETF is a solid addition for any portfolio. And SCHD is the clear winner for any time horizon for your dividend ETF. But you'll also want a quality growth ETF or two for the long haul. My modern 3-fund portfolio has had superior results to all dividend ETFs, SCHD included, over the last decade plus, while also cash flowing deceptively well. If you want more details about how you can get set up with a simple, passively managed 3-fund portfolio that has blown away the market over the last 10 years, check out this video right over here. Thanks for watching, and I will see you next Thursday. Peace.